The moment you deposit $100 into your bank account, something strange happens. That money isn't actually there anymore, not the way you think it is. It's not sitting in a vault with your name on it. It's not stacked in a drawer, waiting for you to come back. Within hours, it's gone. Loaned out, invested, multiplied, and used by people you will never meet. Your banking app still shows the number, still says $100, but that number is a promise, not a possession. Here's why this matters to you right now. Every dollar you've ever deposited has been quietly working, just not for you. Meanwhile, your safe savings account pays you next to nothing, while inflation eats away at what's left behind. You've been taught that saving money means it's safe. But what if the very system you trust to protect your money is the same system quietly draining its value? Stick with me. In the next few minutes, I'll show you exactly where your money goes the second you hit deposit, and the simple shift that lets you take back control. Let's start with the basic lie we're all told. Put your money in the bank and it'll be safe. Technically true, but safe doesn't mean growing. Here's the uncomfortable math. The average savings account in America pays around 0.4% interest a year. Inflation, most years, runs at 3% or higher. That means the money sitting in your account isn't standing still. It's losing purchasing power every single day. $10,000 sitting in an average account for 10 years grows by roughly $400. Inflation, over that same decade, can quietly erase $2,000 or $3,000 of real value. You didn't lose money on paper. You lost it in reality. But here's the part that shocked me the first time I learned it. While your money earns almost nothing, the bank is lending that same money out at 6, 7, sometimes 20% interest. Mortgages, car loans, credit cards. They're using your money to make money and paying you pennies for the privilege. So, where does your money actually go the instant you deposit it? Legally, your balance isn't a pile of cash sitting in a drawer with your name on it. It's an entry, a number the bank owes you. The actual cash moves, almost immediately, into loans for other people. Most of us assume banks keep the bulk of our deposits on hand, just in case. That's the myth. Banks aren't required to hold a fixed percentage of every deposit in reserve the way people assume. What actually limits how much they lend comes down to capital rules and risk management, not a vault sitting half full. Here's what that really means. Across the entire banking system, deposits support far more lending than the cash sitting in any single account. Your $1,000 gets loaned to someone. That borrower spends it, deposits it somewhere else, and that bank lends a portion of it out again. The cycle repeats quietly, all day, every day. It gets even stranger. By most estimates, physical cash makes up only a small slice of the money that technically exists in the economy. The rest, the overwhelming majority, is just numbers, entries, promises passed between banks. Your salary, your rent, your entire financial life is mostly digits, not paper. A bank doesn't get rich by holding your money still. It gets rich by keeping it moving and paying you as little as possible to look away. So why do smart, capable people leave tens of thousands of dollars sitting in accounts earning almost nothing? Here's the part nobody realizes. This was never a math problem. It's a psychology problem. Behavioral economists call it status quo bias, the brain's built-in preference for how things already are, even when a better option sits right in front of us. Moving money feels like effort. Effort feels risky, so we do nothing, and nothing feels safe. There's something else at play too. Call it money blindness. It's the same reason you don't notice a fridge humming until it suddenly stops. Once your paycheck lands and the number goes up, your brain files it underhandled. That balance becomes background noise instead of an asset you actively manage. Banks understand this better than anyone. That's exactly why switching accounts feels complicated, why better rates are buried 3 menus deep, and why the account they hand you on day one is almost always the lowest paying one available. Friction is the business model. As long as your money never moves, they keep the entire gap between what they pay you and what they earn, lending it out. Now here's where almost everyone makes the wrong conclusion. They assume fixing this requires more income or some complicated investing strategy. It doesn't. Picture two friends, Maya and Jordan. Same starting salary, same apartment building, same $20,000 saved by age 25, same intelligence, same work ethic. Jordan leaves his money exactly where it landed, in a standard account earning next to nothing. 30 years pass. By 55, once you account for inflation, that $20,000 has barely grown in real terms. Some years, it's actually worth less than when he started. Maya does one thing differently. On a single Saturday afternoon, she moves her $20,000 into a high-yield savings account, averaging a modest 6 to 7% a year. She never touches it again. No spreadsheets, no stock picking. By 55, Maya's money isn't $20,000 anymore. It's over $130,000. Same starting point. Same effort, really. About 20 minutes of paperwork on one afternoon. But one of them let inertia make the decision, and the other made it herself. That gap is worth more than a decade of extra work. So what do you actually do with this? First, split your money into two categories. Money you'll need soon, and money you won't. Anything you'll spend in the next 3 to 6 months, rent, bills, emergencies, keep that liquid and easy to reach. Everything beyond that shouldn't sit in an account earning basically zero. Move it into a high-yield savings account. Today, those can pay somewhere between 4 and 5%, roughly 10 times a standard account, with the exact same protection. Second, treat your bank like a tool, not a home. Banks compete for deposits because they need that money to lend out. That gives you leverage. Use it, the same way you'd shop for a flight or a phone. Third, remember that saving and growing are two different jobs. Saving protects you from emergencies. Growing protects you from inflation and time. You need both, working at the same time, not one pretending to do the other's job. You started this video believing your money sits quietly inside a bank waiting for you. It doesn't. The moment you deposit it, it starts working. For someone. The only real question is whether that someone is the bank or you. None of this requires more income or a finance degree. It requires one afternoon, moving your money to where it's respected, instead of where it's simply convenient. So the next time you check your balance and feel that quiet sense of safety, ask yourself the real question. Tonight, while you sleep, who is your money actually working for?